Thank you for joining us. This is BARR Financial Services video market commentary for the second quarter of 2010. After completing extensive research, we provide these commentaries to share with you our insights to the economy and the markets. I'd like to say that I'm not a market psychic by any stretch. In fact, I'm a staunch believer that no one can accurately predict future market movements or timings. We hope you find these commentaries helpful, insightful, and beneficial. After 4 consecutive strong quarters for the stock market, the S&P 500 index dropped 11.4% in the second quarter, leaving the year-to-date loss at 6.7%. Other stock markets fell as well. Smaller stock Russell 2000 index falling 10.2%, and the EFA international stock markets dropping 13.7%. The fears of sovereign debt default of Greece in particular, and the impact of the support of European countries on the global economy likely explain much of the concern. The breather the markets took after such a strong comeback and the concern over a possible double dip may worry investors who are still rattled by the drop of 2008. But as a long-term disciplined advisor, I try and separate market psychology from fundamentals. Over the next several minutes, I will share with you why I believe the foundation has been laid for a favorable 5-year appreciation in stock prices. There is always a wall of worry to climb, and the opportunity of the best time to own stock seldom comes with announcement of an all-clear signal. I would also like to point out that investment opportunities invariably arise from such troubled times. There are concerns and issues to be addressed and dealt with. We will share with you our insights into these issues and our concerns about 2011. Many leading economists feel the current market is undervalued. According to the analysis completed by Jeremy Siegel, professor of finance at the Wharton School, suggests that the market is about 25% and maybe even 30% undervalued by long-term trends. Basically, what we've done over the past 10 years has gone from an overvalued market to an undervalued market, which is not unprecedented. There are several indicators that concur with this opinion. As we review the S&P 500 index, valuation measures the latest readings are well below the 3, 5, and 10-year averages. The S&P 500 index at inflection points indicates there is still a large upside potential when compared to the prior recession. And finally, one of the most reliable indicators is the forward PE ratio, which currently is at 11.5 times, well below the average of 16.6 times. These indicators lead us to believe there is still room for the market to grow. In my opinion, there are 3 chief concerns that have resulted in the second quarter's market disarray. They are, in order of importance, the sovereign debt crisis in the Eurozone, the fear that the United States and other developed economies collapsing back into recession, and concern over China's policy response to its emerging property market bubble and more general inflation problem. Eurozone debt crisis. The implications of the sovereign debt crisis, Greece in particular, we are concerned that Europe is facing an extended period of anemic economic growth relative to the rest of the world and will likely experience substantial depreciation of the euro. The action taken to date within the Eurozone was helpful but not decisive. They may have held off a near-term restructuring of Greek debt and relieved the developing liquidity crisis in Portugal and Spain, but they have not addressed the long-term sovereignty concerns of the most precarious debtors. The negative outlook for Europe itself is expected to act as a serious drag on its performance relative to the rest of the world, economically and financially. Double dip recession. Of the forecasters that I look at, none of them had negative growth rate for GDP. In fact, none of them that I respect, and I look at a lot of them, were even below 2%. To have a double dip, you really have to have at least 1/4 of negative GDP growth. Many of these forecasters rate the possibility of a double dip recession well under 20%. What we have experienced is a slowdown, which should reaccelerate by the end of the year. Corporations were quick to respond to the recession by chopping payrolls and investment spending. This has led not only to a leveraged recovery in profits and cash flow, but has also sharply improved balance sheets. The liquid assets of non-financial corporations has reached their highest point as a percentage of short-term debt in 55 years. In other words, companies are in a position to spend. Business investment rose at a 17% rate, the largest increase since the first quarter of 2006. Since cash flow generations tend to lead to business investment by roughly a year, it would be normal to see additional business spending gains through the next several quarters. As I pointed out in the last commentary, inventories have been reduced economy-wide to extremely low levels. The Conference Board's leading economic index decreased 2 of the last 3 months, but its level is still about 4.5% above its previous peak before the recession began. Moreover, the gains among the LDI components have been widespread, with the exception of housing permits and stock prices. This suggests an expanding economy, but at a slower pace in the second half of the year. The housing market slump and high unemployment continue to be strong issues that need to be addressed. Until the leadership of this country takes action to reduce unemployment, it will continue to slow the economy. China syndrome. China's credit explosion last year could have inflationary impact and cause soaring property values. Local Chinese stock markets have fallen in excess of 20% in the quarter. In addition, some metal commodities have posted steep price declines on the worry that China's growth will be lower as they attempt to deflate the excessive property values and deal with general inflation. Growth in China should remain robust relative to other countries, but the rate of gain will likely slow as the cumulative effect of the yuan appreciation become felt and the government takes additional measures to rein in inflationary pressures. In summary, the painful bear market and global recession remains firmly lodged in the psyches of investors, leaving many of them a bit gun-shy. The second quarter is a quick reminder of how volatile the market can react. The media paints a very pessimistic view and ignores important influences that could result in a more positive outcome. First, low interest rates and a very expansionary monetary policy remain intact in countries facing fiscal pressures. Second, corporations in the U.S. and Europe are in strong financial shape. The recovery in manufacturing continues with the surge in world trade and strong demand from emerging markets. Worries about a double-dip recession beyond the most sickly debtor nations appears premature at best, even as the fiscal noose is poised to tighten in 2011. Third, I believe valuations appear quite reasonable when measured on a global basis. We firmly believe that the diversification of our portfolios will continue to benefit our clients. We are currently in the process of making strategic changes to our portfolios and look forward to discussing those changes with you. Please forward this email to your friends and family so they can benefit from this information, and let us know how we can better serve you. Thank you for your ongoing support and confidence.